Hello, everybody. Welcome back to TraderInterviews.com. Thanks very much for joining me for another show this week. And today we're going to do something a little bit different. I spoke with Cynthia Kase at the recent Traders Expo and took a look at some of her charts and the way she looks at the market. So I wanted to get her on the phone today and talk to her about that and show you some of her slides as well. So, Cynthia, thanks for joining me on the phone.
You're welcome.
Well, let's talk about kind of your overall approach to the market. Can you kind of describe your philosophy about trading and investing?
Well, my focus has always been more on the trading side. I started out in the markets as an oil trader. And so my focus has been, as opposed to selecting an instrument that looks good, in developing techniques to trade a particular instrument of interest. For example, if one's a crude oil trader, you don't have the option to trade corn if corn looks better than crude. You have to trade crude oil. If you're a wheat trader working for a large food company, for example, you don't have the option to trade crude. You have to trade wheat. And so my focus has always been in very precisely trading a particular instrument of choice as opposed to what I call blunt instrument trading, and that is trading a large portfolio, cutting your losses and letting your profits run with very simplistic systems. Our approach has been to precisely enter, precisely exit a particular a commodity or issue.
Okay, so you're developing ways to look at the markets that would apply to any market then?
That's right.
Okay. And one of the things that I wanted to talk about right off the bat was case bars, because you kind of developed a unique way of looking at bars in the market. Talk about that a little bit.
Well, years ago, back in the 80s, I began to think about volatility and how volatility is really the life and breath of the market. And I began to think about the market three-dimensionally. As maybe a torus, where in actuality the diameter, so to speak, of the market would expand and contract based on volatility. So I thought of time charts as looking at, let's say, the diameter of the torus expand and contract. So, for example, if in a given hour an hourly bar was $1 high, then the diameter was $1. If the bar was $2 high, the diameter was $2. And I began to think, well, is there a better way to look at the market rather than just time? And I thought, well, why not normalize the market charts for volatility and look at bars with equal volatility? So, because volatility is kind of the underlying measure of the market, I thought it would be better to look at the market based on volatility. And just to give you an idea, volatility is proportional to the square root of time. So I wanted to look at something that was directly proportional to the x-axis, not proportional to the square root of the x-axis. So very simply, what we decided to do was to look at the market based on a measure called average true range. And the first time I read about the average true range was in a book by Wells Wilder, New Concepts in Technical Trading, which was published in the late 70s. And so I decided to develop bars, price bars, that are equal average true range as opposed to time on the x-axis.
All right, so looking at the first slide that our viewers are watching in the video here, the bottom right shows you, on the left is kind of what regular bars would look like, and then on the right side of that is what your bars look like, because they're all the bars become the same size now.
That's right. The ticks that make up the price action, the actual transactions and prices reported that make up the price action are the same. Okay, the prices are the prices. However, the way that the bars start and end on the left is dictated, let's say, by a 60-minute bar, 5-minute bar. On the right, it's dictated by the range of the particular bar.
Okay, how does this help you then see the markets more clearly?
before we go I have got a couple of slides that show you that. Just want to make the comment that on this slide is the formula for the true range, if anybody's interested in that. So going to the second slide.
We're on the case bars versus time bars now.
Okay, so if you look at case bars versus time bars, this is gold. And let's start out by looking at the right, which is a standard 60-minute chart. You can see that there are some very large bars going up, some very small bars chopping around, and that during periods of sideways consolidation, the market has become very choppy and very difficult to trade. If you look on the left, you can see much cleaner price action. That whole choppy period at the beginning of the chart is condensed into a clean move up and a clean move down. And then when the market starts to move up, the choppiness at the beginning of the move basically disappears, and you just get a nice clean move up, and then a clear correction down, nice move up again, and more clearly on the move down after the peak towards the right-hand side of the chart. If you look at gold, you can see that there were a number of small bars, and then the move down took place in basically 1 hour, with another large move down the following hour. Where on the case bar chart, the move is broken up into 4 or 5 bars of equal range, and makes it much more easy to trade, to enter the market, to see the charts, etc.
All right, so could I apply then a moving average or something else along any other indicator to case bars as well?
Yes, you can. We're going to see an example of that in the slides. Shall we take a look at the natural gas chart where we have the candlesticks?
Let's do that. We're talking about the slide now, case bars versus time bars, NGN10.
Yeah, I wanted to specifically show the case bars with candlesticks because some people mistakenly think that case bars is a different type of bar. In other words, it's not an open, high, low, close bar or a candlestick. So the case bars is essentially equal range on the x-axis, but the bars and the candlesticks display like an open, high, low, close bar or a candlestick normally displays. And here, for example, you can see that there was a huge drop down in 1 hour, and on the case bars, that one big hour gets broken up into many, many different hours. I think maybe 6 to 7 bars, and you can see the decline much more clearly and trade it much more easily. And then the sideways move that took place overnight gets compressed into a couple of bars as opposed to the sideways small range action that we see overnight on the hourly candlesticks.
All right, so because I have more bars, I can start to see this decline more clearly than if I saw it just happen in one bar. Is that basically the essence of it?
Well, you can take advantage of it. I mean, certainly you can see it on the right, but you can take advantage of it because you get a signal. The indicators update after every bar, right? So rather than waiting until the move is over before you get a signal, you'd get a signal somewhere after maybe the first or second bar down, as opposed to waiting till the move is over and then you get the signal.
Got it. Okay, so if I'm trying to automate my system, maybe I'll get a signal earlier than I would than if I just had it at the end of the bar.
Yeah, I mean, regardless of whether it's automated or not. I mean, if you're using manual moving averages or stochastic or whatever you're using, you're going to get the signal sooner.